I'm gonna talk about speculative bubble, and the case study here is 2007 financial crisis that happened in the U.S. So, we have these graphs that kind of shows the speculative bubble that happened in different countries. One of them is in Japan. It's stock market, so the price of stock is going up, 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 up until around 1990, and it goes down quite dramatically. And same as home price in the U.S. and residential property prices. It's same thing, real estate price. In China, it's going up in this period, and it goes down quite dramatically here. Very sharp decline, right? These are bubbles, okay? Uh, so before we get into this more in detail, let's start with keywords. We need to know what speculation is. Speculation is buying and selling of assets with expectation of profiting from appreciation in their value. So you buy those stocks or houses hoping and expecting that the price will surge later, so you can sell it and get a profit. That's what speculators do. It's different from actual investment. For example, if you buy houses because you want to live in that house in long term with your family, have a good life, that is not speculation. That is actual purchase of home. That is more like an investment. Um, Same as when you buy stocks of a company whose idea is actually really good. You think the business idea is amazing. You believe that they're going to be really making a lot of profits in the future because they have good ideas, and you buy the stock, uh, gaining partial ownership of that company. That is also not speculation. But speculation is you buy it and hope the price will go up in a short term, and you sell it so you can enjoy the profit that it gives you. That is speculation. And then it leads to this very important concept in this video, which is speculative bubble. Speculative bubble is a situation that occurs when mutually reinforcing investor optimism raises the value of an asset far above what can be justified by fundamental value. So, what it means by mutually reinforcing is that when price of house, let's say, surges, a lot of people join the market and buy those houses because they tend to assume that the price would continue to rise, so they want to get profit from it. So a lot of people join the market, and that actually realize the further surge in price, because when a lot of people demand the houses, the price will be driven up. And when price is driven up further, that also attracts even more demanders, right? And that is mutually self uh, reinforcing, and it's like a positive feedback mechanism. So that's how speculative bubble happens. I'm going to explain about those other three words later. So let's start with, why does a speculative bubble happen? We want to answer this question clearly. So there are two important reasons why speculative bubble happens in any economy. So firstly, people extrapolate price appreciation. When you see price of something going up, you tend to expect that to continue, right? It's believed that they would continue to rise. So that's the reason why surge in the price of a stock attract even more people, because a lot of those people extrapolate the price appreciation, so they can buy it and they can sell it later, because they can get, well, by doing so they can get a lot of profit. A lot of people extrapolate like that. And another reason is that people follow the herd. It's part of this is, I guess, psychological. They don't want to get left alone. You don't want to see everyone around you buying stocks and getting a bunch of profit over time, and just see that happening. You don't want to just see that happening. You want to join them. You want to follow them. You want to do the same things, so you don't get left alone. And as long as that price surge continues, you feel like you're missing something. You feel like you're missing the opportunity when everyone around you is getting will experience the price of their assets surging, right? Appreciating. So that's another reason why surge in price of stock or house kind of attract even more demanders, driving up the price further. And as a result of this, appreciation of assets call for further demand for it, leading to more appreciation. Right? Price goes up, a lot of people come and buy it, uh, driving up the price further, and that attracts more demanders, speculators, investors. So that's how a bubble happens. An example of assets that can be subjects of speculation, or those things. It can be real estate, stock, and it can be bond, loan, or loan asset. Remember, bond is type of loan. It's a by buying bond, you kind of uh, you can get back the principal and the interest on it, right? It's a promise that borrowers would pay back the principal and interest, and by uh, holding bond, you can receive that, and it can happen for foreign currency. It can happen for literally anything, like tulip, right? It actually happened in Netherlands apparently 200 years ago, 300 years ago, or maybe more recent. I don't know. Uh, a lot of people start buying tulip, so the price of tulip goes up, and people see that happening, and people extrapolate. Remember, and also a lot of people join the market, so a lot of people just follow the herd. They don't want to feel left alone. They don't want to see everyone around them being successful when they're not, by being conservative. So they join the market, driving up the price even further, and that continued until people eventually lost its confidence, and some people start selling it, and the price goes down a bit. And when people see price going down, same thing happened. Extrapolation. A lot of people sell it. It's gonna cause a cycle of selling and driving down the price and further selling, right? So the important idea here is that when speculation happen, the value of asset, the price of asset, goes far above what they can be, what can be justified by fundamental value. So when tulip price went crazy high in Netherlands in this period, it's not like these tulips were becoming more and more useful or beautiful, or it's not like people were liking tulips more and more necessarily. That was not the case, right? That's what I mean by price of tulip or assets going way above what they actually way more than the fundamental value that they have. Same as real estate speculative bubble, when housing market goes crazy and the price goes up, 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 up. That doesn't mean that people are actually, more and more people are loving living in different houses, enjoying the houses, so they want to buy. It's not like that. It's simply because speculators buying it for the purpose of getting the short term, well, the profit by selling it in a short term, right? Same as stock, same as bond, anything else. So that's speculation. And let me explain what actually happened in 2007 financial crisis in the US. Okay, so the context is that interest rate was low, partly because of expansionary monetary policy. I looked at federal fund rate. It was quite low, meaning that the government was actively increasing money supply, driving down the interest rate. So it was easy for people to borrow money in this period, and there was also steady rise in home price. Okay, and this was kind of like the perfect formula to for the speculative bubble to stir, because price was surging and it was easy for people to borrow money. So millions of would-be homeowners, people who were considering buying houses, they thought like, okay, it's the best time to buy houses, right? Because it's easy to borrow money to buy houses. Remember, they can take out the mortgage and buy houses, right? And the price of home is also rising, which means that if they wait a bit more, it's going to be more expensive in the future, so they would rather buy it now. So a lot of homeowners rush to buy this. And same as speculators, a lot of speculators saw that happening, price of home going up. They're like, let's buy it now and wait for a few years, or even more, and sell it later so that we can get the profit. That's what a lot of speculators said. So those people, speculators, potential homeowners, they all rushed into this market and bought houses, which actually drive up the price because demand increase, price increase. So many of the mortgages granted in this period were subprime mortgages. Okay, and let's look at the definition. What is subprime mortgage? Subprime mortgage is a mortgage given to someone with poor credit, probably people with less stable jobs, people who have history of maybe debt, or people with debt, or people who with poor credit history or something like that. So those people are typically excluded from normal mortgage market. They can't really borrow money because banks don't trust them. Banks think there's too high probability of default, so they don't want to lend it to those people. But when it comes to subprime mortgage, they kind of charge a bit higher interest rate, so they can actually extend those service for poor people too. So that's subprime mortgage, and that was what was actually increasing so much in this period, in this speculative period in the U.S. in the housing market. A lot of people are borrowing money. A lot of poor people or people with poor credit history were able to borrow money quite easily from commercial banks, retail banks, and they bought houses, right? And they were able to actually get borrow money at unusually low rates. Okay, so that's why a lot of people were borrowing. A lot of poor people or people with poor credit history of borrowing money to buy houses. And why was that happening? There are three reasons. Okay, three very important reasons. So first one is securitization leading to moral hazard. Okay, two new concepts, I would say. So let me explain the definition. Securitization is a process of pooling various kinds of loans, slicing and sorting them according to their risk levels, and repacking them into financial instruments. So it's basically, slicing and packaging different loans and bonds and sell that package. So that was becoming more common, and that was kind of like a revolution in this period. That was not possible before, but it became possible in this period. So a lot of commercial banks and retail banks extend loans to a bunch of people, and including subprime mortgage, and they kind of slice them and break them and repackage with different bonds, different loans to businesses, to different households, and they just sell it to someone else. It can be other banks, it can be investment bank, it can be private investors, whatever. Okay, so that was securitization, and original lenders like banks easily sold off their loans assets because of this new process of securitization, right? Securitization kind of allowed them to easily sell off the loans that they've created without holding it for long term, right? If you make loan and you hold that loan assets in long term, that means you're the one who bears the risks when you extend a loan to someone with poor credit history who might default, right? It's your fault for doing that, and you're gonna get the damage by yourself. However, from the perspective of those commercial banks, it was so easy to just extend loans, very risky loans, and sell it off because of securitization. That was happening, and that is called moral hazard. What moral hazard mean is that the creation of incentives that encourage excessive risk taking because of protection against losses from the risk. So those commercial banks were able to extend very, very, very risky loans to a lot of people with poor credit history because they're not the one who will eventually receive the damage when default actually happened, because they were able to securitize it and make them into package. Put them into package with different bonds and loans and sell it to different banks, investment banks, right? So that is moral hazard. They're not the one who actually receive the damage when default happens. So that's why banks were extending so much subprime mortgage with relatively low rates than before. Okay, and another reason is securitization leading to complexity of evaluating the risk of those financial assets packaged by commercial banks. So the complexity of these assets made it hard for investors to be aware of risk, thus they traded these assets assuming high rates of return. So imagine, right, you're investor and you're gonna buy different securities, bonds, loans, and commercial bank is selling this package of hundreds of different loans and bonds. Is it easy to evaluate the risk? No, because so many different loans and bonds mean that was such debt is held by so many different parties, so many different people. You can't fully grasp the idea about how risky they are, how high the probability is in terms of the default, right? So you just buy a lot of those investment banks or other investors in this period were assuming high rate of return. They're like, I think it's fine. It's kind of hard to fully evaluate the risk of it, but I think it's not that risky. A lot of people are underestimating like this. That's why the trade was very active. So securitization continued, meaning that the extension of very, very risky subprime mortgage with low rates were actively going on in the economy due to those and retail banks, commercial banks were the one who were doing it. Okay, another reason is too big to fail. It's a very important concept when we study financial system in economics. And that also leads to moral hazard. What it means is that if investment banks were to suffer from insolvency, meaning having more like having more liability than assets, the government would have to bail out to prevent the domino effect of the bankruptcy. So they purchase those banks end up purchasing risky assets. So what it's saying is that a lot of investment banks were buying those subprime mortgages, or the package that includes subprime mortgages, that a lot of those banks were actually aware of the risk, right? They're like, maybe it's quite risky because it is a subprime mortgage extended to people with poor credit history who may not be able to pay back the full debt, right? Those banks were not like stupid. They were aware of it. But they were also aware that they're not gonna receive a huge damage even if the default happens. Because if those banks see their asset uh, depreciating by a lot due to default, uh, that can be that can lead to insolvency. But the government will help them, right? Government don't want, well, they don't typically, well, usually they don't just let those big investment banks fail and bankrupt and suffer from insolvency, because that can lead to different firms or different uh, bank business also failing too. So a lot of government in the world kind of intervenes to help them, and they knew that U.S. Government would also do so. So that's why they purchased those risky assets, right? Let's just buy this because we can get high return potentially, but even if we fail, uh, the government will help us. That's moral hazard. Okay, so just like any other, so those three reasons, those three things are the reasons why extension of subprime mortgage was very, 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 very active in the U.S. economy in this period. So a lot of people were buying houses, and that drive up the price of houses further. And this positive feedback mechanism just continues. It amplifies the initial change, which is surge in price. So the price of houses continue to rise. And a lot of people who bought these houses were speculators and poor people who have poor credit history. And just like any other bubble, the home price started falling as speculators lost confidence and sold houses that they had bought before. So here's what was happening here, right? I think it was around the end of 2007 that kind of started happening, and people realized that price is falling. So a lot of people follow them in selling houses, driving down the price even further. And with rapid falling price, countless homeowners defaulted, right? Due to reluctance to keep paying more than what it actually worth. Imagine you're the one who bought those houses with the subprime mortgage. You bought this house, you have to pay back the fixed amount of money because that's the debt that you got from the bank. However, the value of the house gets lower, meaning that you have to pay the debt back over the course of, like, let's say 30 years or 20 years or even 40 years. However, the value of that house is far below that. Do you want to do that? Not really, right? Maybe some people will still continue, but a lot of people thought it's crazy. They don't want to continue, right? They obviously don't want to continue, and they would rather default, right? They just give up paying them back. Of course, their houses will be confiscated as a result of it, but they thought it's better than continuing to pay a huge amount of money for 30 years for something that worth less than that huge amount of money that they have to pay back to the owners of the mortgage loan assets. So a lot of people defaulted, and countless default happened. And what is that gonna lead to? Mortgage loan asset lost their value. That was the result, right? Imagine you have mortgage loan asset. It's kind of like you can claim, by holding that loan assets, you have right to receive the payment, whether if it's yearly or monthly or quarterly. You will get the right to get money by holding those assets because borrowers have financial obligation to pay for it. However, if they default, they will no longer pay for it. Unfortunately, they will no longer pay to those people who hold the assets. And what's going to happen to the value of the assets? It goes down quite dramatically. That can be wiped out. So various financial institutions face the problems of assets being below liability exceeding assets. Okay, because it's not and nothing has actually happened to liability. It's the problem is that the value of the asset has gone down very dramatically, right? The subprime mortgage loan assets that those financial institutions, including investment banks, commercial banks, and private investors held, became worthless. Some of them, not all, but some worthless, because so many people said, so many homeowners says, we're not going to pay back. We can't. We're not going to pay back to those whoever hold uh, uh, the mortgage loan assets that yeah the initial banks has created, right? They're gonna say that, so those assets became valueless, well, worthless, or at least the value will be diminishing. And home closures didn't help much. Of course, banks can conduct foreclosure. They can confiscate the house and sell it and get some money. So they can at least get some assets. So the decline in the assets will be mitigated. However, that won't help much, especially considering that the price of those houses has dropped quite dramatically. So even if they sell it, they it's gonna be, well, it was far less than what they could have got if those homeowners kept paying back the debt. So it was very catastrophic. Okay, so many banks suffer from this issue, liability exceeding asset significantly, and that's a failure. That's good. That's insolvency. So many investment banks, such as Lehman Brothers, went bankrupt. Okay, they failed and had to be bought by others or bailed out by the government. So it was like a chain effect. When Lehman Brothers, big investment bank like Lehman Brothers, bankrupt, a lot of other banks do get impact from it because, for example, Lehman, uh, some banks may have borrowed money to those big investment banks like Lehman Brothers, and they have failed. So they can't. Uh, they have they have no way that they can completely avoid the effect damage of it. So a lot of financial institutions received huge damage because of bankruptcy of some significant banks, but also because of the fact that they were holding very very risky assets, which was subprime mortgage loan. Without even, well, I wouldn't say without even realizing, because they were aware of what it was, but it was not like they specifically bought subprime mortgage from commercial bank that has extended it or that has created it. They bought the package of, remember, they bought the package of so many different loans, which did include subprime mortgage loan. So maybe a lot of them were not fully aware, and a lot of people suffered, a lot of banks suffered, and that was the financial crisis that was happening. Thank you.